It is my belief that things don't just happen by chance, but by proper planning. Do you have a retirement plan or simply have an investment portfolio that can use some fresh ideas? Hi, my name is Mike Ecker, and my podcast is called Investment Choices. In my podcast, I will be speaking with professionals who will be discussing alternative investment ideas that may be a good fit for your financial plans. There is more to investing than just stocks, bonds, and mutual funds. Hi, everybody. This is Mike Ecker. Welcome to my podcast, Investment Choices Other Than Stocks, Bonds, and Mutual Funds. I hope everybody is safe with what's going on with the COVID virus. Practice social distancing. We don't have masks on because we're doing a Zoom, just to let everybody know. So I have with me John Moyer. We're going to talk about index-linked annuities today. John brings over a decade of experience in the financial industry. He has extensive experience working with advisors and individuals to uncover portfolio needs and develop appropriate investment and risk management plans. John currently holds a Series 7, 6, 63, and 65 certificates, as well versed in the financial markets. John attended Stonewall College in Massachusetts. He holds a BA in Economics and Business Administration. John and his wife live in Connecticut with 4 boys and Puck, their German Shepherd. Big German Shepherd, John? Or a little one?
80-pounder. Could be a handful at times for sure.
I'm sure. It's like God, you got a big pooper scooper, huh?
Absolutely.
There you go. Thanks for being with me today, John. I really appreciate it. One of the things I want to talk about, because a lot of people have mixed feelings and not understanding annuities. And today I want to talk about index-linked annuities and how they fit into a portfolio. Can you give us an idea?
Yeah, absolutely. When you look at index-linked annuities, they're a relatively new type of annuities. They're a variable annuity. And like other annuities, they're a long-term financial product designed to help accumulate assets on a tax-deferred basis. This type of annuity, index-linked variable annuities, allow you to participate in growth opportunities up to a cap by tracking the performance of a market index while enjoying a level of protection in down markets to help portfolios withstand volatile times and get people to their ultimate goal of financial independence. And as an added benefit, probably different than most annuities folks are familiar with, many index-linked variable annuities do not have any annual fees.
That's one of the things that people always ask me about. The fees in annuities are unbelievable. But this type of annuity has no fee?
That's correct. There's no fee. The carriers are able to, offer these products through the way they're constructed, and the financial instruments they use to provide the downside protection, which we'll talk about a little bit later, the upside participation as well. Baked into that is a way to make it profitable for the company while still giving clients full participation in the upside with that added insurance, that balance of some downside protection as well.
Okay, so really, I guess I'm looking for, give us a breakdown, how do they actually work? How do they put together?
So every index-linked variable annuity is a combination of a few different factors. It's going to be, you're going to choose an index to track. Many of them are
Standard & Poor's or something like that, an index?
Correct. S&P 500, very common. MSCI EFA, if you're looking for some international exposure outside of the US or Canada. Russell 2000 for small caps, if you want to be maybe a little more aggressive in the approach. So you'll track an index over a segment, over a time period. Based on the return of the index, your account will be credited growth up to a cap. On the downside, the market experience a loss over that time period, the loss would be reduced by a buffer that you could choose, say, absorbing the first 10% of loss. So market goes down 8%. your account's credited, brought back to flat, you do not see a loss. Market goes down, say 12%, your account's again credited 10% with a 10% buffer, and you'd only realize a 2% loss. So pretty attractive value proposition, especially based on where we are in the markets today with low interest rate environment, the challenge of equities coming back from such a sharp drop off. There's a lot of interest and has been in recent years, been one of the fastest growing segments of the annuity marketplace, one of the fastest growing investment segments as well.
One of the things you mentioned, and I'm not sure everybody understands, can you clarify what a cap is? Like with
Sure. Sure. So the way these portfolios are constructed, you'd have, when you choose a buffer, you're basically choosing the level of risk that you're comfortable with for your client. You could choose a 10% buffer to absorb the first 10%, 15%, or 25% of loss before your client's going to see any negative performance in their account. And these different levels of protection come with a corresponding cap. The lower the buffer, the more risk, the more reward. The bigger the buffer, the lower the risk, the lower the reward. Give you an example. Say you're looking at a 15% buffer. That's going to protect you, historically speaking. If you're looking at S&P performance, there's a study that tracked S&P performance going back to the start of the index, and looking at 684 rolling time periods. A 15% buffer would have protected clients from realizing any loss 97.7% of the time. Something like that would probably come along with, say, a 200% cap on the upside. So over a 6-year time period, you track an index, the S&P, you have room to grow your account more than triple. You put in 100,000, you can grow it to 300,000 before you're in a situation where you're hitting the cap. And to give you perspective there, average return for the S&P over a 6-year period is 57%, just a hair over 57%.
With that time period, I see. I just want to preface in here that we're talking about generic. We're not talking about anyone specifically investing in anything. This is for educational purposes, and people should talk to their investment advisors, their consultants, their registered reps before they make any decision. We're just trying to educate on the different properties of the annuities and how they work in general. So please don't take this as a type of investment strategy. It is not. It's just an alternative investment that's available to certain people if it fits in your situation, and your investment consultant would probably know best. So again, I just wanted to point that out as a little disclaimer that we're not promoting anything. We're trying to educate. How long have they been around, John?
Absolutely. They've been around since 2010. And there's been a number of new companies entering the market in recent years. They've been really seeing quite a bit of popularity growth recently, as we were, hitting all-time highs in the past few years. If we look to 2019, investment flows for index-linked annuities, in 2019, year over year, sales were up 39% year over year, growing to 17 billion in 2019. And the strong interest, the strong flows have persisted through the first quarter of 2020 with year over year sales growth, investment growth of 44% through the first quarter. And again, just looking at the environment that we're in right now, I'd say we're probably going to see continued interest in the strategies moving forward here.
These are actually insurance products, is that correct?
That's right. That's right. They're classified as a variable annuity. When people think variable annuity, as you were mentioning earlier, they may have looked at variable annuities in the past. But if you looked at the variable annuities right after the financial crisis, say 2008, 2009, these products weren't available. Annuities, like any other product, respond to the market. They respond to financial markets and consumers, as well as consumers' wants and needs have evolved. So have the strategies. So they're similar. They're variable annuity, but do some things a little bit different. Have a unique value proposition, I would say.
I was going to say, what is the difference? A fixed annuity, a fixed index annuity, and a variable annuity. I heard the variable annuities are very high in their fee structure, where you said the index one had no fees. How does an insurance company make money if there's no fees?
Well, the pricing is baked into on the index linked variable annuities. The pricing is going to be baked into, again, to the construction. So when an investment's made into one of these strategies, the carriers will employ an option strategy to hedge against loss for the buffers, and also give the client the participation in the upside. And this option strategy, because they're doing it on such a large scale, because they have such flows coming in behind them, they're able to get some favorable pricing, make it more profitable for them, and they're able to price it, give your client the upside, protect on the downside, and still have potentially have some left over to invest for themselves and make a profit on the strategies.
But the principal investment, how is that protected? The principal?
The principal, they're still, so it's a variable annuity. It's, if you're thinking of fixed index or fixed strategies, those are principal protected. There's less risk. So the upside, there's not as much opportunity for growth. They work great as a portion, a conservative portion of a portfolio. But if somebody's looking for a little more growth potential, they might look to variable annuities. Some variable annuities will have to be strictly an investment vehicle, no living benefits, no riders. And those fees, could be relatively similar to a managed money account. When you start to add on living benefits and things like that, that's when those fees can start to creep up. But with the index linked, it sits somewhere in the middle. So you're taking more risk than a fixed indexed annuity, but there is that built-in protection, so slightly less risk than a variable annuity. So you sit somewhere in the middle of having that comfort of protection, balancing protection with the performance, the upside participation, and growth opportunities.
So it's a balance. In other words, again, you have to look to your financial consultant and talk about the safety factors. Would you looking to take more risk in? Like you say, the more risk, the more return, less risk, the more guarantees. You mentioned the living benefit account. A lot of people are talking about that today. Could you elaborate a little on the living benefits? What are they actually, how do they work?
Sure. So living benefits are, if you think about traditional variable annuities, many of those will have the option to add a living benefit where those will lock in performance, lock in investment growth for the purpose of creating an income stream, or perhaps lifetime income stream. That's where those living benefits really work well as a way to potentially boost retirement income. This strategy does not have a living benefit account. The protection, if you're in a situation where there's a loss and in a buffer, these strategies will credit the client's account value. So, any structure or index-linked variable annuity that you're looking at would be building protection into the account value, not a living benefit. One thing when folks think about living benefits, there's some very attractive opportunities, but depending on the strategy you're with, you may be in a situation where if you close the contract or do not turn on income, the living benefit isn't going to bring you value. With protection built into an account value, that money's yours at the end of the surrender schedule, or when you see fit, you're able to withdraw money. You can take the money and reallocate as you see fit, turn on income. There's a number of options that an account value allows you.
So like a living benefit is a steady stream of income for a period of time that they choose, either lifetime, 10 years, or whatever it is, but that's a living benefit. Is that correct?
That's correct. That's correct. And, where we see index linked variable annuities used is primarily as an accumulation vehicle. So this is really for, say, folks who are in a position where they're going to be taking income later or possibly much later down the road. And it's a place where they'd like to grow they have a longer time horizon, and they're looking to take advantage of tax deferred growth to build their income base for the future.
Where are the investments coming from, this kind of money, usually?
We're seeing folks, you mean from a typical kind of client?
Yeah.
Age-wise, it's we see it just like any other variable annuity. Somebody in the 45 to 70 age range, with the majority of folks coming in somewhere in the mid 50s to mid to late 60s is where the bulk of the flows are coming from. But do see some folks outside of that as well. And in terms of types of accounts, we see both qualified and non-qualified accounts, leaning a touch more towards the qualified accounts as people look to roll into a traditional IRA structure and build in some protection for a portion of their assets.
Are they customizable?
Yeah, absolutely. Each index-linked variable annuity is a combination of time, of participation, or participation to a cap, and protection as well. So within that, there's a number of choices across each. If you're looking at an index, again, you mentioned the S&P 500. That's one that there's across the industry high level of flows going to the S&P, because when folks think of the market, they think of the S&P for the most part. So high level of flows going to the S&P. But as mentioned, MSCI EFA, which gives you exposure to developed countries, developed economies across the world, excluding the US and Canada. I think it's about 21 countries at this point. That's another popular one to diversify a portfolio. The other one you might see commonly is Russell 2000 for some small cap exposure as well. That's another common one across the industry. Gives you a little more growth potential, I guess, upside potential, and again, diversification as well. If you're looking,
you can diversify between a couple, then 2, 3, it doesn't really matter.
Right. And you can get more diversified than that. Many of these strategies, you could start in one, shift to another, go back, however you want to do it that way. But then you'll also have different levels on buffer, different levels of protection. You could be in the S&P and have, some with a buffer at 10%, some with a buffer that's, greater than that, maybe say 15, 20, 25%. Buffer protection. You could structure it however you want, and you could also have different segments. Some strategies offer a 1 year, a 3 year, or a 6 year, and you can allocate between different indices across different segment time periods with different buffers. So you could get as customized as you want. I'd say most of the folks, the bulk of the dollars do go to the S&P 500, across the industry, but there's definitely exposure to everything else as well.
Well, I always think of it as a buffer, as a downside protection if the market goes down. And I think this product definitely could fit in. What are what's a minimum type of investment in this? What have you seen as a minimum type investment?
Minimum investment for these would probably be, depending on which strategy you're looking at, somewhere in the $10,000 or $25,000 range. So, relatively low threshold for investment there. Typical flows or typical allocation we'll see is somewhere in the $125,000 range is pretty standard, I would say.
Okay. Well, I really appreciate your time, John, and it's not as simple as people think. There are different types of annuities. Again, this is Mike Ecker. The podcast is called Investment Choices Other Than Stocks, Bonds, and Mutual Funds. And John, I want to thank you. Please stay safe, you and your family, at this trying time. And again, everybody out there, stay safe, social distancing, and please wear your masks when you can. Again, have a super day. This is Mike Ecker. Have a good day, everybody. Thank you for listening. Remember, things just don't happen when it comes to your financial future. This is Mike Ecker, and you've been listening to Investment Choices.